The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events.
This is the time when you say, with a very sane mind, I see what's on the horizon and I don't like it. These changes put me at a disadvantage, and quite frankly, I'd like to put my family at an advantage. And it's one of the reasons why, quite frankly, price volatility is meaningless to me in terms of gold and silver when I look at the changing structure of finance over the next few years. I don't want to be treated like a patsy.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. David, our guest last week, Jim Grant, was great, and he's now pointing out something that could be very, very scary. Rarely ever do you see 100% consensus in the markets. Now, we've talked about this before. When 100% of, say, money managers are thinking the same thing, that's usually a signal for danger, not a signal that they're right.
Well, and again, you're talking about near consensus or a majority vote. And it is close to 100% of analysts recently surveyed agreed that interest rates would rise. This is a very difficult lesson for most people to grasp. And this is sort of thinking about group thinking and crowd psychology. How can so many intelligent people be wrong at once? You know, in our household, I was raised with the adage that the majority is always wrong. I mean, always may be strong, but almost always might be the right approach there. And I guess I've always been, on that basis, suspicious of a consensus view. In this case, we are talking about professional money managers. I mean, there's new studies, whether it's heuristics or social behavior, that you can get a very concise and clear explanation of this kind of group dynamic. But the easiest way to approach this, suffice it to say, you make decisions when you're investing, and the easy ones are the ones that are supported by your peers.
Well, you know, I mean, that's just human nature, Dave. I mean, most people are a little worried when they think that they're the only one operating a certain way. You're usually looking, well, I'll give you an example. You're looking for a line at the theater, okay? And if I go into a sushi restaurant and I'm the only one there, I don't eat there. Okay.
Sometimes we forget that peer pressure in professional circles is far greater than what you'd even find on the playground or in high school. I mean, think about it. If you're unpopular in your teenage years, you're unpopular. You don't have hanging over you the threat of being fired.
Where money manager might if he's not doing the right thing.
Exactly. Job insecurity if you're out of step with the rest of the industry. And so everyone decides a market is going one direction, and no one then is left to actually come in and move the market that direction. That's the danger of consensus in any investment theme. Again, it's a little bit like everyone loading onto one side of a boat.
Right.
You're increasing the risk of something that gets out of hand, and call it a tipping point, if you will. But that's the issue, is when everyone moves to one side of the boat, it's a naturally dangerous place.
I'll give you an example of that that's actually Durango-centric, Dave. You know, we have the Durango-Silverton narrow gauge railway, and as you know, we have beautiful views. There is that one view, though, that everyone has seen on the postcard, which the train is on the cliff, and you look down about 300 feet down to the riverbed, and what's interesting is the view is so fascinating and so wonderful that everybody runs to the same side of the car. And, you know, I've always wondered, are we going to have this thing just flip right over the cliff? And, you know, going back to what you're talking about, though, when you have, and this is sort of counterintuitive, you would think that if 100% of the people who are managing money think a market's going to go that direction, that it would continue to push. But what the problem is you have everyone invested and you run out of buyers, and there is a reversal. All it takes is just the snap of a fingers for a few people to create a panic to the other side.
Well, then this is what you're talking about. Momentum trends do work for a time. You're building unanimity. Then an apex is reached, and usually that's an inflection point at the same time. So you have people who are basically taking the Fed at their word. The poll reveals a certain amount of certainty amongst market practitioners.
You've been talking about certainty over the last few months. I mean, certainty in a market. What is your certainty?
Certainty that rates will rise.
Okay.
Certainty that a rise in rates is a sign and symptom of economic recovery. A certainty that the Fed will do as they've said they would do and raise rates.
Well, unemployment. We're actually looking at the employment numbers, and they said when it hit a certain number, they're going to start raising rates. Now, how come that's not happening?
Well, this is the interesting thing. Everyone's based their certainty on the Fed's commitment to raise rates. It's just a question of now or later. But the Fed committed to raise rates as soon as the employment rate hit 6.5%.
But they say we're below that now, Dave.
We've inverted the numbers. The rate has magically gotten to 5.6%, and we still have sort of the divergence of opinion among Fed hawks and doves on when to raise rates. They already committed to do it. They should have done it last year, mid-year, and yet they haven't.
So are they worried about something? I mean, what is it that they're seeing that worries them?
That's definitely in the back of my mind, because taken at their word, 6.5% was the number which was to trigger Fed action. That number is now long in the rearview mirror. What does the Fed see on the road ahead? What's keeping them from following through? I mean, this is, I think, worthy of consideration. In the absence of follow-through, what's the consensus view of inevitably rising rates? What's that based on? Mm-hmm. And so I guess we will take the other side of the argument, both for the sake of argument and because we think there's a legitimate case to be made for it. In this way, we do agree with the likes of Jim Grant that rates will go lower before we see the heights of a bond market panic. Do we think that rates will ultimately go considerably higher? Yes. Tomorrow? No. In the interim, we have a number of reasons to believe that they may, in fact, go lower.
Well, last night, Dave, I was reading The Economist magazine, which isn't necessarily the bastion of conservative economics. It's more of the management type of economics that they analyze.
Neo-Keynesian.
It is. But the article that I was reading talked about how we're in a unique situation at this point. We've got incredibly bloated worldwide debt because of the crisis from 2008 on. We've lowered interest rates to almost zero, and we're really not getting recovery. I mean, granted, the United States is trying to make it look like there's a recovery, but now what you have a situation that we didn't have before. We bloated the debt, we lowered the interest rate. Now to raise the interest rates, what are you going to do? Slow down an already slow economy? And it's a critical juncture, I think.
Well, that's right. If GDP growth numbers for 2015 are expected to stall at all, then the Fed is in the real pickle. How do you exit? How do you tighten, as you say, by raising rates in an environment where we don't have robust economic growth, but we might in fact see a decline in GDP growth. So the argument for lower rates rests on, I think, at least four issues that you have in play. Number one, you've got emerging market bonds. They have been under pressure, under the gun. You've had prices dropping, which of course is sending yields higher. And treasuries, U.S. treasuries represent a safer pool for the global fixed income investor with a greater assurance of liquidity and a relatively high yield. If you look at U.S. treasuries, it's a decent yield relative to some of the peers that you'd have out there in the marketplace.
Well, and the stock markets for the emerging markets haven't been stellar performers either.
No, that would be point number two. That's another issue in play because emerging market equities have moved in lockstep with the general commodities indices. They've lost value pretty considerably over the last 6 to 12 months. You've had select commodities, oil as the big one, nearly 50% in that time frame down, with dollar assets seeing a rotation, and this is on the basis of perceived risk status and a reappraisal. Do they want to be in risk assets or do they want to be in lower risk assets? And lo and behold, U.S. fixed income has gotten something of a boost there as well.
Well, then I think I should point out, Dave, as you're going through these different points, that interest rates drop when demand increases on treasuries. I know the listener may know that, but it's important to think, why do interest rates go down? Because actually, we're going to see interest rates at some point rise, and probably pretty dramatically. And it's important to understand that when that occurs, that's when bonds are dropping. It's like a teeter-totter or a seesaw. Bonds go up when interest rates go down. Bonds go down when interest rates rise.
Well, it was Keynes who described the market as like a beauty contest where people are voting on who they consider to be the most beautiful person, quote unquote, in this case, asset class to be investing in. And you vote, and the reality may be very different, but we have conceptions of beauty which are temporally dependent. This particular time slice today, you could say, well, to be beautiful, according to Vogue magazine, is to look like a heroin addict, is to look like you fill in the gaps and just realize that 20 years ago, you might have needed to be voluptuous and curvy, and the concept of beauty has changed. Therefore, the vote has changed. So there is this sort of disconnect with reality. Beauty is what it is. is, and the votes that are spelled out in the marketplace are what they are, and they don't necessarily have to match up. So, for instance, this last year, we saw Greek debt winning the beauty contest. In Greek debt, you had 10-year Greek debt trade as low, if you're looking at the yield, as 5.85%.
Right.
Now, that would indicate very little concern in terms of the inherent risks. We would still consider inherent risks.
So using your analogy, that would mean a beautiful pick, basically.
Absolutely.
And no offense to Greek women. I mean, but Greek bonds are a little uglier.
The market was deeming them to, in fact, be beautiful.
But they were just made up by the central banks, let's face it.
Now we're facing a very different reality.
Yeah.
We've had interest rates go from 5.85% to over 10.5% just since August 1.
So they've got rain on their mascara.
This is the point, that sometimes as the beauty contest unfolds and people are taking their votes, they're just wrong.
Right.
They're wrong. And so I would grant you that although people are moving to treasuries on the basis of perception of strength and of security and of liquidity,
right,
market practitioners can be wrong in that appraisal too. They may have a justification for their vote in the marketplace, but they can, in fact, be wrong, and I think ultimately will be proved wrong. I don't think treasuries are the greatest place to be on a 3 to 5 year time frame.
Well, and I look back at the shows, Dave, just from this last fall, the weekly commentaries where you brought up over and over your concern about unusually low rates in these emerging markets and in these BRIC countries. You know, Greece was one of them. Spain is another one. These are countries that are under huge distress, and using your analogy, are actually very, very ugly under the mascara. And yet they're getting beauty ratings of 9s and 10s, you know.
Prettying up the pigs, as they say. So with recent stock market volatility, I'd say this is sort of the third element arguing for lower rates in the U.S. Treasury market in the short run, not the long run, but in the short run. You have U.S. stock market volatility. I mean, we lose 600-800 points, and then you've got an Evans or a Lockhart or any of the cast of characters from the Fed who verbally intervene. We had it October. We had it again in the last 10 days, where if the market sells off 800 points, all of a sudden somebody says, hey, listen, this whole raising rates thing, all they do is interject themselves and a strong opinion into the marketplace to underscore the availability of credit and easy money to the marketplace. In other words, they want those who are partying like it's 1999 to continue to party, and they don't want everyone to sort of pack up and go home quite yet. And I think this is one of the things that sort of confuses the notion of Fed independence. The Fed should care less about asset prices, and yet they really do care quite a bit about asset prices, and that really is outside of their original mandate. They should be the ones who are the sober, adult-like actors who are saying, hey, listen, I think you've gotten ahead of yourself. There's a little too much froth in the marketplace. In fact, asset prices should probably go down. They can't bring themselves to adult-like behavior in this environment. And I think that's one of the things that is deplorable and frankly will be in the history books in terms of the Fed's record of behavior from the Greenspan era through Janet Yellen. They haven't had the backbone to say enough is enough.
Well, and you think about the mandates that the Fed started with and then have added. Okay, the original mandate of the Federal Reserve was stability of money. The second mandate was added in the 1970s. We've talked about it, and that is stability of employment, basically seeing that employment is maximized. But now what you see is a third mandate. The first two we've talked about before could never be matched correctly in the first place. But you add a third body to this, and that body, and the reason I use the word body is in physics there's a problem called the two-body or the three-body problem, and you can calculate gravitational orbits of two bodies, basically. But you add a third one, and it starts to bring in things that disturb that original orbit. And, you look at the Federal Reserve, it's like having a bunch of kids in the car, and everyone wants to eat at a different restaurant. Okay.
It's a little chaotic.
And you're supposed to satisfy everybody. It is a little chaotic.
Well, and in this case, the third body in the orbital spheres you're describing is asset price stability. And they have an operative theory,
the
which
stock
is
market.
Exactly. Yeah. If you have a wealth effect, there will be a boost to economic activity on the basis of the wealth effect. Ergo, we support asset prices. And that's what they have done through the various liquidity measures, quantitative easing 1, 2, 3, whatever they offer for us in the future. future in terms of price stabilization. But here's what you have. Again, my point being, we've had some stock market volatility. At the start of 2015, think about the gyrations already witnessed in the U.S. equity market, and bonds are seeing an increased inflow of funds seeking a safe haven. Gold, by the way, has seen some of those inflows on the same basis, given volatility in the stock market. But we haven't begun to see rates drop in lockstep with, say, a panic sell-off in the U.S. equity markets, say a sell-off of 10 or 20%. That materializes and gets ahead of the Fed's ability to control and manipulate asset prices, and you'll end up seeing interest rates go from their minuscule levels today to microscopic levels tomorrow.
Do you think, Dave, that one of the points for why people would be buying bonds right now is just that the talk is deflation? I mean, you don't hear inflation anywhere. And deflation, what they teach you in the textbooks is when you have deflation or you have low inflation, bonds are one of the better places to be.
Yeah, I think that is a reality. People are factoring the official rates of inflation and saying basically we have no inflationary concerns. Your average fixed income investor is saying if there's no inflation, then I don't need compensation for inflation in my equation of income on the principal I've invested.
But is that an illusion?
To some degree, that is an illusion, but deflation remains in the air. You have the inflationary concerns today. Amongst the investment community, they're nowhere to be found. Now, we do think that people are not looking far enough down the road to see the inflationary dynamics building, but look at, as we've described, the deflationary canaries in the coal mine.
Like Dr. Copper.
Dr. Copper broke $3 a pound last year and has remained below that level. Now, for the international market, less interested on a per pound price, they've looked at $6,000 as a key technical support level. That is $6,000 per metric ton in the copper market. We broke that this week and have remained below $6,000 a metric ton. You have oil cratering. You've got the Aussie and Canadian dollar. Their trends have been very weak, with prices fast falling. All of this argues for investors buying what seems a better bet in a deflationary context, because, as you mentioned, the textbooks say bonds are what you want in a deflationary scenario. Relatively speaking, this may be the case. Certainly last year, the 30-year Treasury proved to outpace even stock market performance. Is anyone aware of that? Is anyone aware that the 30-year bond outperformed the U.S. stock market?
That's hard to believe. It's supposed to be the bastion of safety.
But in fact, 100-year, think about this. This is how skewed the fixed income markets are. 100-year Mexican paper outperformed the S&P 500 last year. Okay? So, I mean, before we get all excited about moving lock, stock, and barrel into the bond market, the beauty contest last year, if you were just sponsoring the U.S. S&P 500 next to 100-year Mexican bonds, 100-year Mexican paper won the day. They were voted prettiest girl. I mean, think of it. So you tell me, with the history of inflationary episodes in Mexico, that's where you want to be?
Well, if you're eating your spinach and you're doing your yoga, you might actually make that 100th year where you can go and pull that bond out at maturity.
What are we suggesting? We're suggesting that the 10-year Treasury yield moves down to about 1.5%. The 30-year Treasury dips to 2% or less, which would in all likelihood mark a generational low. This is what's particularly interesting to me. You may think, well, interest rates and a discussion of them is really kind of like watching paint dry. Things like this only happen once in a generation. So reaching a generational low, it's taken 3 to 5 years to get to these points, and it's taken, frankly, longer than we expected. Admittedly, a far longer process than we expected. Of course, there's been more direct market intervention in the form of orchestrated, manipulated rates than we probably anticipated as well. But this is where we're at. Reaching a low point in interest rates, it does define a business environment for the next 20 to 25 years. When we can establish what a generational low is in interest rates, you know what your headwind is to economic growth in terms of a rising trend in borrowing costs from that point forward. So I think it's very significant, and we're at that cusp of marking the final stages of a bond bull market and the early stages of a bond bear market. Keep in mind how significant that is for the average investor who today takes on not only a passive approach to investing instead of actively managed approaches, but also looks at the bond market and says, I want a bit of safety versus the volatility on offer in the emerging markets or ultimately the U.S. equity markets. guess what happens? You're moving from the frying pan into the fire. Volatility of the stock market to a generational whipping for the fixed income investor. And again, I'm not suggesting that that defines 2015 or 2016, but most investors aren't trading their fixed income portfolios. They buy them to have and to hold till death do we part. It is sort of a ignore the volatility, clip the coupon as you go. And that kind of a mindset is going to separate the average investor from quite a bit of money, the average retiree from quite a bit of money, as they make a very poor choice in terms of moving from what they perceive to be low volatility and high safety in the fixed income market.
Well, and you've said so many times that interest rates are interesting because they're a measure of risk. Okay. And if you look at history, there are things that you can do to say, all right, well, this is a pretty accurate rendering of history because there's a thread that runs through it. Interest rates are the thread that runs through history. Yet what we see, Dave, at this point, if you go back and look at the chart for the last 3 years, it's just flatlining. Okay. It's that pure manipulated rate flatline. And, even, Switzerland, they're negative at this point. People pay money to have their money in the bank.
There's actually about 6 or 8 countries around the world that have officially negative rates. Now, we've been running negative rates in terms of real terms when you factor in inflation for some time, but our official rate is still above water. You actually have a stated negative rate in a number of countries, which is remarkable. And we think that these low yields insanely underrepresent the risk inherent to the U.S. Treasury market and a lot of your European debt markets as well. And that risk has been neglected and ignored for the last 6, 12, 18 months because of the promises of Mario Draghi at the European Central Bank, because of the buying habits of the Japanese and the easy money policies being put in place by Abenomics, because of the continued asset purchases and manipulation of price and yield from the Fed in terms of their expansion of balance sheet up through the end of 2014. We're now in a very interesting stretch of time, and it's not a stretch for us to imagine lower rates when you consider the chaos of the global equity and bond markets set alongside what is likely to be this year a lackluster profile in the U.S. stock market. Now, that has yet to materialize, but that's something we can certainly envision. Low to no growth. And in that context, U.S. fixed income, relatively speaking, catches the attention of investors that have counted on a very different recovery outcome. That is, buy stocks, sit back, let the market grow as it always does. If that conception of investing is overturned and upset, if those expectations are not met, then again, you have a reason for U.S. treasuries to go higher in price and yields to get squeezed. Now, here's the thing. Energy may hold the key to disappointing economic growth in 2015.
I don't know that anybody expected oil to drop by over half, Dave, over the last few months. I mean, we talked about oil back in the spring when Putin went into Ukraine. We talked about how in the past the United States has used oil prices to break the bank of the Soviet Union. But I'll be honest with you, I had no expectation that we would see oil drop the way it did. Did you?
Well, it's interesting. The pundits will often look at some of these indicators when they're favorable to their argument. So let me give you an example. CNBC will say, the price of copper moving higher certainly indicates robust global demand for the commodity and growth economically, not only in China, but we're seeing home ownership increase. We're seeing demand for homes and the use for industrial purposes on the rise. So the rise in copper is always a good thing. But then when we have a decline in copper prices, you just quit talking about it because it's not a bad thing. Okay. It can be a good thing when the price is rising, but it's never a bad thing when the price is dropping. And oil's the same way. Well, listen, you've got robust demand for oil in Asia. You've got the tiger by the tail, so to say, as we see growth expanding and growth rates in China off the charts, certainly beating the developed world by multiple factors. And this, along with an increase in cars on the streets in China. So the story goes. You get the point. The point is you have a positive spin to higher oil prices, and yet then when oil prices drop, there's also a positive spin, and that positive spin is the consumers around the world are going to get the equivalent of a tax break. They've got more money in their pockets, and la-di-da-di-da. That's how the story goes. But here's the thing. The consumer, although they're a significant part of the U.S. economy, are not turning those saved dollars into consuming dollars. The most recent numbers I've seen from, say, the third quarter to the end of the fourth quarter, daily consumption in the U.S., the average person spends $96 a day filling a tank of gas, buying groceries, buying books on Amazon, if you're me. Whatever it is you spend money on, it all adds up to about $96 a day. Well, with the cut in oil prices, now they're spending $98 a day. I'm not trying to belittle the difference between $2, but it's really not that big of a deal, particularly when you consider what is being destroyed on the other side of the equation.
Well, isn't that right? I mean, this miracle that we've supposedly seen here in the United States, and it has been impressive, our energy dependence has turned into energy independence. The high-paying jobs, Dave, are in a couple of states. They're in the energy-producing states right now.
All right. So you've got the high-paying jobs, which have been created over the last 5 years, primarily in the energy sector. One of the guys we work with here in this office, his son was heading off to college and looking at college programs. And one of the big arguments by the Colorado School of Mines was, their petroleum engineering students are graduating and getting six-figure jobs, every single one of them. $150,000 a year jobs straight out of college. Now, that was petroleum engineering 12 to 24 months ago. You're going to see that tighten up considerably. And again, capital spending in the U.S. This is corporations with large budgets to expand their future income. How are they going to expand their future income? What do those investment dollars look like today? Capital spending in the U.S. has been very dependent on the oil patch. Estimates are that oil and other ancillary spending associated with the energy space are about 30%. Now, 45% is probably a more realistic number when you include the spending which is sort of one step removed, but arguably related.
So almost half of the capital spending of the United States has been related to this energy sector.
Right. So now you've got cutting in CapEx. You've got, quite frankly, I don't think government spending is going to fill the gap. Consumer spending, you may have an uptick in consumer credit, but that's not going to come close to what happens with corporate conservatism and budget cutbacks in the oil patch. You've already got rig count idling, which is happening really just beginning in earnest with the implicit personnel idling. So you can expect to see Texas, Oklahoma, the Dakotas, Louisiana, and a few others begin to feel that pinch in 2015. And this is where you've been seeing most of your job. And if you're sort of looking at earnings growth, which in the last jobs number was not nice, keep in mind there's been these states which have helped you average up because of the high salaries and the high hourly wages, again, relating to energy and oil.
So what you're talking about, rig idling, they're not closing down the rigs, they're just putting them on idle, so those jobs are no longer necessary.
Right. So the folks who are actually drilling, they're not drilling as aggressively. So they're basically taking the ability to expand future capacity and saying, wait. We're going to have to just kind of digest what we've already done. Now, the problem is, and we talked about energy independence just a minute ago, it's a little bit of a farce because energy independence, it implies that all of the production we've brought online has a long production profile, a long life, and that's not true. The reason why it's drill baby drill in all these places is because the production profile drops dramatically at the end of 24 months. In some instances, the end of 12 months. So you're getting your best well production in terms of barrels per oil in the first 12 to 24 months, and then it drops by 80 to 90%. So the fact that they're idling their rigs right now means that there's going to be a lot less, move out on the time frame, there's going to be a lot less cash flowing into those companies 12 to 24 months from now. And the energy nightmare has really, in that respect, just and only begun, because if they don't have the cash flow 12 to 24 months from now to make good on the loans which have allowed them to drill as much as they have, you are talking about sort of vast insolvency in the space.
Well, and we're talking about a sector that employs a lot of people, but let's just look at the overall nation at this point, Dave. The employment numbers, you mentioned this earlier, they are really strangely puzzling.
It's positive. It's great news that it's at 5.6%, down off of over 10%.
Are those believable numbers, though?
Well, yes and no. I mean, 5.6% is with the upward revisions from the last 2 months. And so you could say, as the dust is settling, it's an improving picture. I'm puzzled. I am just flat puzzled because you still have the difference between the actual jobs created and the statistical smoothing that occurs along the way. For instance, this most recent number, last week, we were told that non-farm payrolls number was positive by 252,000 jobs. Okay, 252,000 jobs, that beat expectations. Everyone says, okay, that's great. Now the U3 number is at 5.6%. Granted, labor participation fell to a new low for like 40 years, but just set that aside. This is a very positive number. It's not consistent with the household survey numbers, which were actually disappointing. And in fact, when you look at the non-farm payroll number of 252,000 jobs added, it was actually negative 65,000 jobs before the seasonal adjustment.
And a seasonal adjustment is just somebody, an accountant somewhere with a pencil, isn't it?
So this is why I'm puzzled, because yes, it's good news, and yes, business owners are going to make decisions on the basis of employment numbers improving. But I'm sorry, is the number negative 65,000, or is that seasonal adjustment of 317,000 jobs isn't relevant as we in sort of investment public are crunching our own numbers and saying, good news, bad news, indifferent. How do we suss this out? How do we determine how we feel about the number? Well, the actual number was negative 65.
But not with the addition.
Not with the addition of seasonal adjustments, 317,000 as a seasonal adjustment. And you've got birth-death modeling, which actually was a good number by 20,000 jobs. But you let the dust settle. And how many jobs were actually created?
Right.
Your guess is as good as mine. What we do know is that the statistical games delivered a shot in the arm for the average Joe investor. And sentiment is stronger than it has been in the past. I'm just still questioning the evidence. And I'm questioning whether the reasons why people are positive about the U.S. economy are as legitimate as we are told. The question will linger, I suppose.
Well, and not to belabor the point, but pun intended, okay? You talked about labor participation. I think this is critical in this discussion, Dave. It's dropped to 62.7%. What that means is about 63 people out of 100 in the United States actually have a job. So how can we even trust any employment number when you're only talking about a little more than half of the people in the United States working?
I think more than anything, official statistics just underscore our dependence on officialdom, in the sense that we're so confused by the statistics and what they mean that ultimately, if you're a relatively positive person, you'd say, well, we're told that things are improving, they must be.
I think about how we measure things, Dave. What if we had a yardstick that every time we picked it up, it was a little shorter or a little longer, and we continued to make decisions, build houses, whatever, but we've got a continually moving target as far as what we're measuring against. And I'm going to switch to gold here because a lot of our listeners are looking at gold for 2014 and they're saying, well, it was another down year, 2012, 2013, 2014, but just in dollars. Every other currency, gold outperformed every currency in the world, Dave.
It did. And I think what you look at when you're looking at the precious metal space, silver was the one that suffered more probably because of its industrial components. And that's consistent with a lot of your industrial demand. It's also consistent with just being a smaller market. And when you get a little bit of volatility in one, you get a lot of volatility in the other. It helps you on the upside, hurts you on the downside. So silver was the real negative for 2014. Gold was positive in every currency but one. In every currency but one, and that's the U.S. dollar. So as people are sort of checking the stats for 2014, the global community says, actually, gold was a winner this year. And silver wasn't as bad, but in U.S. dollar terms, both were in the red. Now, gold outperformed, again, all global currencies but one, and it actually outperformed all global equity markets with the exception of the U.S. and Canada. And that in itself is also, I think, a remarkable showing in the context where the dollar, if you look at how far and fast the dollar moved in 2014, it really had zero effect on the gold market. And everyone has said, and in fact, we had a recent Barclays report saying, dollar strength and improvement or an increase in interest rates is going to be the death nail of the gold market. Balderdash, look at what just happened. The strongest dollar move in a decade or more, and gold basically finished the year where it began in U.S. dollar terms and actually did quite well in foreign currency terms. And I think a part of the reason we've seen something of a floor in the gold market is China and India continue to consume. They're clipping along. 2014 consumption numbers were not bad at all. Have we had better years? Yes. Will we have better years in the future? Sure. But 3,000 tons taken off the market by those two countries alone, bear in mind, only 3,100 tons came from new mine supply in 2014.
So just about, if we were to look at just what's coming out of the ground new, China and India consumed just about all of it.
They basically took 98%. Well, so physical gold and silver, they continue to become unavailable as countries like China and India continue to crank out the tonnage, both producing it and then consuming it. And yet prices have dropped. And people really do assume that in the context of a price drop, there must be ample supplies. No. Actually, the supply and demand dynamics are still pretty tight and pretty positive. I think that when a price uptrend resumes, the pace of increase will be faster than what we've witnessed over the last 10 to 15 years, which was really defined by incremental, slow, and ordered, measured process in the gold and silver market. Those were sort of the past tense descriptives because the dynamics in the physical markets, frankly, have changed over the last 3-4 years. Supply and demand dynamics have gotten tighter and tighter and tighter. As and when we see, let's say, an increase by 5% in terms of demand, supply is inelastic and the price will move exponentially. Is that this year? Could be. Is it a stretch to 2016? The dynamics are set for a very positive move in gold, and it has nothing to do with the dollar being the death nail for the gold market. Look at the evidence. The best dollar performance in over a decade, and it hardly dents. It hardly takes away the luster of gold for the year. I think that's pretty compelling. On top of that, you've got uncertainty and, again, sort of a reemergent concern in Europe, with Greece being back in the headlines.
Yeah, Christmas in Greece was very, very different. I know the withdrawals in Greece were 220 million euros back in November. Boy, did that accelerate. Around Christmas time, 3 billion euros were taken out of the Greek banks. An amazing increase in withdrawals. Now, that had to do with the lack of elected leadership, but do you think there's going to be a bank run in Greece, or do you think the euro is going to finally let Greece go?
I think for the intelligent investor, you've got to look at the currents and tides that are changing for all investors around the world. You can say, look, we've got another crisis, perhaps like Cyprus, in the Greek banking system, where maybe they capture some of those Greek depositors' assets and hold them, turn from deposits into shares. If you
bail in.
Yeah, a bail-in. But I think the bigger concern is not really with Greece. We mentioned this a month or so ago. The G20 meeting in Brisbane was a game changer, where, implicitly these countries participating have agreed to change the quality and the character of what a depositor is in a liquidation process.
The very nature of a deposit turns into an investment, does it not?
You are now behind. This is what the agreement was. It still has to be implemented. But these are the tidal changes, the tidal shifts that people need to be sensitive to. Why do I own gold? In part because I want money out of the financial system. I want a financial asset that's outside of the banking system. Why? Because the G20 is figuring out every way they possibly can to steal from depositors. Basically, the banking system is being restructured, and the average depositor doesn't know that they will, over the next few years, stand behind a series of creditors, and that their deposits aren't just a plain vanilla deposit. But again, they are in a lower pecking order in terms of priority in the case of liquidation for a bank. This is disturbing. If I was a Greek depositor, would I have pulled funds? Sure. If I was a U.S. depositor, would I pull funds? Listen, we're not in a moment of crisis. This is the time that you do pull funds.
Right.
This is the time when you say, with a very sane mind, I see what's on the horizon and I don't like it. These changes put me at a disadvantage, and quite frankly, I'd like to put my family at an advantage. And it's one of the reasons why, quite frankly, price volatility is meaningless to me in terms of gold and silver. When I look at the changing structure of finance over the next few years, I don't want to be treated like a patsy.
Well, Dave, one of my clients was talking to his church board, and he just looked at all of them, and he said, we've got all of our money sitting in the bank. We're earning virtually no interest. Can you explain to me why we have all of our money in the bank? And the thing is, we all have habits. You and I were raised putting money in the bank. When we get paid, we put money in the bank. But actually, the banks aren't paying us right now for the risk of the loss of our deposit. And so, the world is facing something like this. The Greeks, actually, it's right on their front windshield, okay? And that's why 3 billion euros came out. Half of that came out in one day, did it not?
The big changes, I think, for 2015, 2016, and we're going to end with just a slight reference to the Summers-Barsky thesis. Lawrence Summers wrote a paper late 80s, early 90s, where he describes the relationship between gold and other assets. And he looked at gold doing well in a period of low to no rates of returns. And in the fixed income space, we have that. In the last few years, we've had a positive rate of return in equities. And lo and behold, there's been a sentiment shift, which is negative directionally for gold and positive for stocks. You've been able to get a positive rate of return in the U.S. equities market, and that puts gold at something of a disadvantage. But according to the Summers-Barsky thesis, you take away the carrot of positive returns, whether it's in the equity market or in the banks or in a fixed income or bond investment, and guess what you end up with? People asking the question that Church Board did. Why are we doing this? Why do we have all of our eggs in a non-productive basket? And in that moment, people say, I would prefer to have a part of my assets in gold. That was the determination. That was the calculus, if you will, that was concluded in the Summers-Barsky thesis. In a low real rate environment, people move to gold. Take away the competitive nature of U.S. equities, and I think we're smack dab in the middle of a raging bull market in precious metals. That could begin tomorrow. We'll have to see how 2015 gets sussed out, how it plays out, but certainly we've got the dynamics in play. Cyclically adjusted price earnings multiples for the S&P 500 are the third highest in U.S. financial market history. The only two times that stocks have been more expensive, 2000 and 1929. You tell me if this is a bargain basement price. You tell me if stocks sell off by 1,000 points if you're coming in and buying a value. I'm going to have to cry balderdash on that. I don't think so. I don't see it. And I think we are looking at a major trend change for 2015, one that has been sort of positively oriented to equities and U.S. bonds, and ultimately one that transitions initially positive towards U.S. bonds, negative U.S. equities, and ultimately positive for the gold and silver market. Remains to be seen. Last year was not a glorious year, but it certainly was not an embarrassing year either. And I think this one might actually be a glorious year for the gold investor. Let's wait and see.
You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. You can find us at McAlvany.com, McAlvany.com. Give us a call at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.